If you've looked at your phone bill lately, you know how insane wireless plans have gotten. For example, this is our monthly bill from T-Mobile, $140 a month for 3 lines that somehow manages to become $224 a month with all the extra fees and taxes. Now, all you out there in the Bowtie Nation know, I don't buy anything without a dividend stock to cover it. So today, I'm going to try to find a monthly dividend stock to put enough cash in my pocket and pay this off every single month. Our first monthly dividend stock, AG&C Investment, ticker AG&C, has one of the highest dividend yields in those mortgage REITs, a 14.4% yield. It is a great dividend, but I wonder if it's just a little too good to be true. Can it pay for those bills month after month? A mortgage REIT, or real estate investment trust, is a special type of real estate company. These REITs borrow money on short-term rates, then leverage that up by borrowing 2 or 3 times as much to invest in long-term mortgages. What you see here is the interest rate on repurchase agreements, a special overnight short-term rate many mortgage REITs use, and you can see here it's been at almost nothing for much of the last decade. They then use that borrowed money and other capital to invest in those mortgages with the higher rates. So if you take the 4 or 5% interest rate received on a 30-year mortgage minus the near zero rates they were paying on that borrowed money, it's been a very profitable business and great dividend cash flow. AG&C holds a $61.3 billion portfolio of these mortgages, 91% of that in 30-year fixed terms, and most of those in safe agency mortgage-backed securities. Now, 2 things you need to watch when investing in any of these mortgage REITs like AG&C, though, is the book value per share and the net interest spread. Now, book value on the left here is that value of the mortgages the company holds, and you can see that this has dropped consistently since the last year as those interest rates increase. The problem here is as interest rates rise, that's going to mean those old mortgages and the bonds are worth less because they pay the lower rate compared to new mortgages. For example, the rate on a 30-year mortgage has doubled from under 3% last year to almost 7% recently. So anyone holding those old mortgages as an investment, the portfolio just isn't worth as much compared to new bonds. The good news here, though, is that the stock is trading for a significant discount to that book value. Here you can buy shares for $10 each, a 20% discount to the actual value of the mortgages held in the portfolio. Now, that discount to book value is always a good place to start when you're buying these MREITs. Another piece of good news here is in the net interest spread on the right. That's the difference between the interest the company pays on its borrowed money and then what it collects on new investments. And you can see that that profitability is getting higher. So once interest rates level off or stop increasing so quickly, this could again be a great cash flow stock. Now, I do like that long-term potential for AG&C, and it's a great dividend yield, but checking the dividend history, it just has not been consistent. Well, not consistent in a good way. Looking through this, we see the company has lowered its dividend amount consistently every couple of years, from over $1 per share in 2013, totaling 7 dividend cuts in just the last 10 years. Now, I do like AG&C for its dividend yield, but it just doesn't quite meet all the criteria to pay the bills, so I'm gonna have to look somewhere else. I need to find a dividend stock that can consistently pay my bills. And finding that perfect dividend stock isn't going to be as easy as just finding a list of monthly dividend payers. I don't know if I'm going to be able to find a stock that pays monthly to cover my phone bill. Now, I've still got 2 more stocks I'm watching that might be able to make that sell payment, but I'm not just about to drop a list of stocks in your lap and say, go buy these. I want to show you what I'm looking for in these cash machines and how you can use your dividend stocks to pay your bills. And first up, naturally, we're looking for dividend stocks here with high yields. The average yield on dividend stocks in the S&P 500 is just 2.7%. Now, that's higher than the 1.5% yield you get across the entire stock market, but still not nearly enough to pay your bills. And here, remember, dividend yield is the percentage cash return that you get each year from the stock. It's the dividend payment divided by the current price. And you can find this by clicking on the statistics menu here on Yahoo Finance and then scrolling down to the dividends and splits information for any stock. For example, Apple pays a 92 cents per share dividend throughout the year. Divided by the share price of $146 each means it's paying a return or a yield of 0.63% annually. The problem we run into trying to pay our bills with dividend stocks is you're going to need to invest hundreds of thousands of dollars in most dividend stocks, even for a smaller bill. At just 0.63% yield, you'd need to invest $457,000 in shares of Apple to make that $240 monthly bill. So for these, I'm going to be looking for stocks that pay at least a 5% dividend yield. It still means you're going to need to save up to invest, but you'll be paying your bills with dividends a lot faster than with some of those other stocks. Now, for stocks in our list, I'm also looking for a consistent history of dividend payments. Your bills are consistent each and every month, so you need a dividend stock that's going to be just as consistent. And unfortunately, you just can't say that for all dividend stocks or even monthly dividend payers. For example, that 21% dividend yield on shares of MFA Financial seems like it would be the perfect stock to pay your bills. It's not a monthly payer, but at that yield, you only need to invest about $14,000 to pay your cell phone every month. The problem here is this stock has been tragically inconsistent with its dividend payments, increasing in some years while cutting in others. So we're going to need to find the stocks with a history of dividend payments, and for this, you can go to the Historical Data tab on Yahoo Finance. Click through to the time period you want to see, and then to Show Dividends Only to see all its dividends paid. And you can see here that MFA has done a great job of increasing its dividends since the pandemic, but cut that payout by 75% in 2020. It paid an 80 cents per share dividend from 2014 up to the pandemic, but that was cut from $1.12 per share in 2013. And scrolling through here, you can see that volatility in the company's dividend, increasing it one year just to cut it the next. Now, that's not to say that MFA cannot be a good dividend stock. Even when it cuts the payout, the yield is still a really solid one, but if you're trying to match your bills with a dividend stock, you need that consistency to know that the money is going to be there when you need it. Finally, before revealing that next stock, you can't just rely on a history of dividend payments. Finding these stocks, the best stocks to buy, you need to look at the company and how it's going to pay those dividends in the future. Now, this includes things like the payout ratio, growth in profits, and debt. Now, later in the video, I'll show you exactly how to do this and make sure you're getting the best dividend stock for your money. Next is a monthly dividend favorite of mine, Stag Industrial, ticker STAG, with its 5.1% dividend and strong consistency, increasing the dividend from 10 cents a share in 2013 to $12.20 per share this year. But is it going to spin off enough cash flow to pay the bills? Stag owns 450 industrial and warehouse properties across 38 states for a total of 91 million square feet. And while real estate companies have sold off this year, I really like the future potential for this company. And that rise in e-commerce and online shopping has just destroyed the retail property market, but all those online orders need to be stored somewhere, and that's meant a boom in warehouse demand. In fact, 43% of Stag's property portfolio is involved in e-commerce activity. So with Stag, you're not only getting a monthly dividend stock that pays 3 times the yield you get on regular stocks, but also a part of that real estate market that should drive returns for decades. In fact, shares have already produced a 274% total return over the last 10 years. Now, I own shares of Stag, but not to pay my phone bill. You see, the problem here is, while it's a nice dividend compared to other stocks and you end up making a good return with the price, it's just not the kind of cash flow that makes it easy paying the bills. For example, on a 5.1% dividend yield, you would need to invest almost $57,000 in shares of Stag just to make that $240 monthly payment. Here you can see how to find the amount you need to invest to pay your bills. Now, since dividend yields are in annual terms, so that 5.1% is a yearly amount, a yearly percentage, then multiply your monthly bill times 12 to get the total amount you need. So if you need $240 a month or $2,880 a year to pay your phone bills, then we take that and divide by the dividend yield to see how much we need to invest. So taking that $2,880 divided by 5.1% or 0.051 tells us we need to invest $56,470, then we'll receive that $240 a month in dividends. Now, I need to save some money back to invest and pay our other bills, so I'm not ready to spend it all on Stag just yet. That means I'll need to find another stock, one with a higher dividend yield, to make that phone payment. And I think I found it in our last dividend stock, but I also want to share with you 3 things I'm looking for when I analyze a dividend stock. We looked at how to find these. Now I'm going to show you how to make sure you're buying the very best. Now, first here, again, is going to be the payout ratio, or some kind of measure of dividend coverage. Now, the payout ratio is just how much the company pays out each year in dividends, so that dividend per share amount divided by the earnings per share. And you can usually find this here on Yahoo under the Statistics tab. And if you think about this, how much the company pays out as a percentage of its earnings or out of total earnings, the importance of this measure just really comes out. For example, if a company is paying 80 cents a share in dividends, but only making 60 cents in earnings, that's something that isn't sustainable, and the dividend is going to have to be cut eventually. And one thing to understand, for REITs, so real estate investment trusts, and BDCs, or business development corporations, the measure you want to use here is the dividend divided by cash flow, or funds available instead of earnings. These types of companies book a lot of depreciation in their income statements. And I'm not going to get into the accounting because it's only interesting to nerds like myself, but it just means that earnings reported aren't a good measure of actual cash flow. But again, with this, you just want to make sure that the company is paying out less in dividends than its earnings or its cash flow, so it has some sustainability in those cash payments. You also want to look for a company's sales and earnings growth. Now, both of these you can see here on Yahoo under the Statistics tab, scrolling down to the income statement data, or by clicking on Analysis, you can see the analyst expectations for sales and earnings growth this year and next. Now, every company has a year or two of hard times, especially in a recession, but a company needs to have that revenue and profits grow if the dividend or the share price is going to grow with it. I'm going to reveal that third dividend stock next in our list, but I want to get your input on this as well. I'm looking for other dividend stocks to pay my bills. Which ones do you think I should look at? So let me know in the comments below, which are your favorite dividend stocks? Here it is, the monthly dividend stock I'm using to pay my phone bill. Shares of Gladstone Capital, ticker GLAD, with its 9% dividend. Now, Gladstone surely doesn't offer the highest dividend yield among monthly payers, but it's a solid return, and it's been consistent with that payout for more than a decade. The company is a business development corporation, or a BDC, which kind of acts like a banker for mid-sized companies. When a company grows too big to get a loan from its regional bank, but it still isn't quite large enough to issue shares on the market, it goes to a BDC for a loan or for investment. And that business model gives Gladstone the reliability and cash flows to pay its dividends, collecting on those business loans, but also some upside potential when it makes an investment in a company. In fact, before the recent market crash, shares have produced a 147% total return just over the last 5 years. And that return could come back in a big way. As interest rates increase, the rate the company collects on its new loans will increase as well. The weighted average yield, the line here in the chart, is the average return the company makes on its loans. And you can see here, it was far higher before the pandemic. The average yield on loans was over 11.6% in the 5 years through 2019 versus just 10.5% during the pandemic. As interest rates increase and the company gets that average yield back up, the cash flow will return and both the shares and the dividend could increase. One thing we haven't covered in this video, something I've talked about in the past, is if you're investing a lot of money in these special types of companies, the BDCs, the mortgage REITs that we talked about earlier, you need to pay special attention to the company's sources of capital for its business. For example, every BDC is going to show you the industries in which it loans and the types of loans it's making. You see here that Gladstone is well diversified across 17 industries, so a major event in any one group probably isn't going to materially affect the company. But what do you think? Is this the best dividend stock to pay your phone bill? I use it to pay mine, and here's why. With that 9% dividend yield, I'll need to invest just $32,000 to receive the $240 in dividends every month and pay my phone bill. That might seem like a lot, but understand that's $240 a month for as long as I hold the stock. It's a recurring monthly cash flow that I can count on and use for anything I want. It doesn't even include the price return on the stock. Now, if you really want to take on your bills head on, check out the video on the right for 7 stocks to make your car payment. 7 stocks to put you behind the wheel of your dream car. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.